Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Nick Twidale, Chief Market Analyst at ATFX. So quite a lot of turbulence this morning. Here are the latest numbers. The Nikkei dropping some 1,475 points or so, a drop of 3.7%. That is less than the worst levels of the day, Nick. We've got strength in the yen, dollar yen at the moment, 142.76. We just got some weak economic data. It doesn't seem perhaps to be the right time for raising interest rates in Japan. Do you think that we might get some comments from Japanese leaders in a few moments trying to help stabilize things?
Yes, thanks for having me on, by the way. It's been, I suppose some people were hoping for a bit of a quiet start to the day, but already we've seen sort of 70 odd points in dollar yen. I think you're right. It's been a dramatic change from the moves that we saw on Friday when we heard that Ichiba had got in, and it was a surprise to the market. I think we lost nearly 3% on dollar yen. But it's been kind of a nice little spike up back into the mid-range this morning. I think we're back trading around 142.80. The data doesn't look great today, and it probably backs up that he's come across a lot less hawkish over the weekend. Hence, we've seen this move. But it looks like there's going to be plenty more volatility in Japanese markets today, and it wouldn't surprise me if we see a lot more headlines coming out from Japanese government officials as the day goes through.
Hey, Nick, to what extent is this a dollar story as well? I mean, we had that very cool reading of U.S. inflation Friday. Not a lot of dollar weakness, but the market's beginning to kind of get a sense that the Fed may move another 50 basis points to cut another 50 basis points in November. Is that at all a part of the story here?
I think so, yeah. It was kind of the perfect storm for dollar yen bears on Friday with the Ichiba story and then the weaker PCE. I think we're now coming round to, I suppose, the Fed, and we'll know a lot more at the end of this week, that the Fed coming in line with the market, that there's a stronger possibility we do get 50 basis points from them at the next meeting. Well, if you'd asked me even just a week and a bit ago, I was, before we got that 50, I was firmly still in the 25 basis point cap, and probably, 50 over the two meetings. And now suddenly I've changed to nearly 100 basis points. So the market is very volatile. You can't ignore this week's employment numbers. And obviously we've got non-farms and the unemployment rate on Friday. But before that, we've still got another three quite key job numbers with JOLTS, ADP, and the weekly unemployment claim. So all of these, I think, if they show a cooling in the US economy, we're going to be we could be by the end of the week looking much, much more certainly at a 50 basis point cut from the Fed. And that's just going to put more pressure on the dollar.
Of course, there's also other ways of looking at it. Job conditions may not be as bad as feared in the U.S. We may get a slightly more positive report than expected. And then also, if you look at the Japanese data, we mentioned the weakness in industrial output, but retail sales was actually stronger than expected, which kind of shows you that, there's a lot of ebb and flow in this. There's volatility in the numbers as well as in the markets.
I think so. We're not getting, and from a lot of jurisdictions across the globe, aren't we? We're not getting that consistency of data, which kind of makes it interesting for us in the FX world, because we're getting these really sharp moves and counter moves. But I'm kind of in your camp with the US as well. I'm thinking that, if we don't see poor data in the jobs numbers this week, then we could see a real reversal in fortunes for the dollar, because it's not changed dramatically, I think, from what we've seen, but clearly the Fed's now moving away from that inflation focus, and we're really looking at employment numbers. So, like you said, we look at this dollar yen positioning at the moment. Yet you've got a terrible industrial production number, but stronger retail sales. So we're getting these contradictory pieces of data across the globe, and it makes for interesting trading conditions, but it certainly doesn't help the trend followers.
What are you seeing right now in carry trades? I mean, the yen used to be the dominant force there. We saw what happened a couple of months back. I mean, what is the leading funding currency these days? Is it still yen?
I think overall, yen is still the leading funding currency. We're seeing a lot more in emerging markets, and certainly in our market, we're still seeing the yen and yen crosses are still popular because even though we are seeing this massive decrease in US yields, it's still a relevant trade. So we did have that horrible crash back in August, but I think it's still a relevant trade for a lot of players out there. And once market conditions maybe normalise, if they normalise over the next few months, it can come back into play. But it's a harder trade. I think it's once we see these volatile conditions, it's an easier trade for the yen players because you've got liquidity in those markets. Where we've seen some carry trades across the emerging markets, obviously you can then get really stuck with the spot positions and they can come unstuck very quickly. So I think yen's still the most popular play for the carry.
I just had a look at the dollar in the last 20 minutes or so. It is actually down 4% since July. So, and that goes back to before we were starting to get giddy about rates coming down. So the dollar move, again, like you say, it's volatile. We don't know for sure whether this trend continues. But given that the Fed is probably, pretty much on a cutting cycle now, the extent of which we don't know, but it doesn't look like any hikes anytime soon. Is that something we can kind of bank on, a weaker dollar gradually, at least over the next 6 months?
I think so, but then once again we've got to look at individual currencies. So you start to look at, and we've got key data out later this week from the Eurozone with CPI numbers, and like Europe does not look good at the moment from a number of perspectives. So when you look at the dollar, and obviously you've got a heavy reliance on the euro within both the Bloomberg Dollar Index and the more conventional one.
That's a good point. Yeah.
As an FX trader, when we talk the dollar, we have to look at the euro, and I can't personally justify too much more topside for the euro dollar. And I think because of that, we could see a change in the prospects of the dollar itself, because, as you said, we've seen like a 4% decrease already, and so FX markets do tend to get ahead of themselves, and we price things in 90 seconds that the real world takes 9 months to come to fruition, right? And so maybe we have overpriced a little bit more of this downside for the dollar, because certainly we've seen that big decrease, and with increased geopolitical tensions across the globe, the dollar's a favourite to go to for a haven trade. So if we see escalations, and let's segue into what we're seeing, you guys were just talking from Israel at the moment, right. Things don't look smooth across the whole globe. So the dollar I think the dollar could turn very dramatically, but it feels like, and I hate to say it, this week could be another pivotal week, right? Because these employment numbers come through, plus if we see how the geopolitical situation plays out, and as we've seen from dollar yen in the last day or so, massive moves in that currency from politics. I think we're in for some interesting times, and maybe the dollar does come back into favor in those conditions.
Very quickly, Nick, 10 seconds. I mean, have we seen a top in the Chinese currency here? We're strengthening quite a bit.
I think we may have done. Yeah, that's going to be a big call for this week. We've got Golden Week as well, so there may be some profit taking that comes through both for the currency and for stocks in China. But the question for all investors is, have they done enough? They've done a hell of a lot, but they've done that for a very good reason.
Great points, Nick. Really, really good to have you on the program. Out of time, unfortunately. Nick Twidale there from ATFX on the markets. Sonia Meskin, Senior Economist for UBS Investment Bank. Sonia, let's talk a little bit about consumer confidence in the United States. Are consumers gaining in confidence or surrendering it?
Well, it's a very interesting question. We've seen two different measures come out last week, and they've painted somewhat divergent pictures. The Conference Board's measure was more pessimistic than the University of Michigan's measure. And we think partly it may have to do with the way that the surveys are collected, but also the timing of the surveys. Because, of course, the Conference Board survey's timing, the question was asked prior to the Fed's cut. The University of Michigan asked the question post the Fed's cut.
Okay, so that seems significant. But when you look at the expectations for inflation, is that beginning to come down as well?
That's interesting as well, because shorter term, yes, in the University of Michigan's measure, the 1-year ahead inflation expectations do seem to be coming down, whereas the longer term inflation expectations appear to be a bit stickier, even as the actual inflation is coming down. Obviously, we had the PCE numbers last week, and we continue to see deceleration there, especially in the headline number.
So when we look at conditions as a result of what the Fed has done by cutting by 50 basis points, are we expecting to see the yield curve steepen? And if we do see longer-term yields increase a little bit, is that because of confidence about growth, in the broader part of the U.S. economy, or is it more about fears of inflation?
Well, that's when the Fed begins to cut rates, the curve naturally steepens, whether just because, obviously shorter term rates are coming down. But in the intermediate to longer term sector, we could be seeing both some more confidence in growth expectations as well as the higher term premium, which really means higher uncertainty. And that's where fiscal concerns may be coming in as well.
So we've seen the Fed kind of pivot away from being concerned about the level of inflation to more trying to deal with a labor market that seems to be weakening pretty steadily here. We've got the non-farm payrolls data due on Friday. I think Economist in our survey are looking at the creation of about 146,000 non-farm jobs in the month of September. How are you viewing the American labor market right now?
We do expect an ongoing deceleration in the labor market, really as a reflection of a broader growth slowdown. GDP growth is expected to slow as well. So these two trends would be naturally consistent. Our own forecast is a bit higher than yours at 180,000 gains for September, and also upward revisions to August, which are very historically common, in part because the response rate in August proper is not particularly high.
I'm curious your thoughts on the housing sector, because you've got a couple of ways of looking at it. Mortgage applications are up, but there's a possibility, I would suppose, that if jobs don't do very well, that the housing market doesn't do very well. So what's going to affect housing more? The Fed cutting interest rates, which would be seemingly a very good thing for that market, or jobs?
Well, both, of course, are important. We've seen in the recent years some pent-up demand in housing on short supply, but few transactions, really. So lower rates are supposed to, of course, help with that. But at the same time, we also do expect some expansion in supply, which would be meaningful.
Away from the market, though, per se, I mean, if you get a lot of refinancing as a result of a lower rate, is that money likely, the money that is saved there, is that likely to enter the economy in a meaningful way, or will it be saved, do you think?
It could be both, and it really depends on which income bracket we're talking about, because lower income consumers do tend to spend proportionally more. And we've seen savings there get depleted a lot faster than the upper income strata.
So everything, it's kind of like checks and balances. Everything has, well, if you look at it from this standpoint, and then you have to look at it from this standpoint, right? So you've got kind of a healthy consumer, but not at the lower end. You've got housing that could do well because of rates coming down, but then you got to watch jobs. On balance, as you look at the U.S. economy, are you positive 6 months out or slightly negative?
I think we would be... we're not expecting anything drastic. We're not expecting a recession. We're expecting a slowdown, which in fact the Fed had been looking to achieve, precisely because that would help bring inflation down. And that connection between strong wage growth and high inflation is something that could be, in fact, quite dangerous in entrenching inflation expectations to be higher longer term. So some slowdown in the labor market would not be inconsistent with the Fed's objective and also our expectation. But we're not expecting anything drastic on the downside.
I'm curious as to what you're expecting, Sonia, to hear from Fed Chair Jay Powell tomorrow when he speaks to the National Association for Business Economics. What are the themes, do you think, that he needs to address if the Fed is going to offer the appropriate messaging going forward?
Yes, it would be very good if he addresses a little bit more how the Fed is thinking about progress in the labor market going forward, and whether, of course, they can't commit to any specific pace of cuts. We've heard from some speakers last week, including, Kashkari, who indicated that he would be, I think, more interested in a 25 basis point pace rather than 50. But really, how the Fed is thinking about the terminal rate and how the Fed is thinking about the interplay between the data and the pace at which they expect to be easing rates. Any more color on that would be very welcome.
Sonia, maybe my last question. If we look at the Fed going forward, are we going to get a new sort of policy framework, some sort of next big move that the Fed wants to make?
Well, the Fed did indeed have a policy framework revision in kind of around the pandemic, and it may be, in fact, one of the reasons why they were somewhat more reactive than proactive when it came to the acceleration in inflation, and that is something that they may, in fact, to some extent reconsider going forward. It appears that they really did not want to be reactive this time around as the economy is slowing, which may be one reason why they cut. They started off with a 50 basis point cut this time around. So that is perhaps something that will come out in their future iterations.
Yeah, let me just sneak this one in quickly before we go. Was it a mistake years ago when the Fed said, well, we think really inflation was so low for so long that we want to let it run hot for a while to kind of balance things out? Was that a mistake then?
Well, they certainly did not expect the supply side shock that we got post-COVID, I believe, when they were saying that. So in a sense, in the context in which they were operating then and the expectations they had further out, perhaps not. But you do get these exogenous shocks, which obviously no one expected, that I think weren't necessarily as in line with the framework that they had laid out.
All right, Sonia, thank you so much for joining us here on the program. Sonia Meskin, Senior Economist for UBS Investment Bank.
Let's take a closer look now at what is happening in the Middle East. It may be fair to say the escalation of violence between Israel and those Iran-backed proxies really threatening to bring these combatants closer to a regional war. Joining us now at the Bloomberg Interactive Broker Studio here in New York, John J. Edwards. He is Bloomberg Weekend America's managing editor. Thanks for making time. I'm sure it's been a busy day for you. So Ed just referred to the killing of the leader of Hezbollah, Nasrallah, in Beirut last week. How is this being received right now in Israel? What's the mood there?
Yeah, actually, the mood in Israel at the moment is, according to our reporting, somewhat jubilant. In fact, Israelis after the long and really in many ways disturbing slog in Gaza are celebrating what they see as a clearer success in the actions against Hezbollah over the last several weeks. Going back to, of course, the attacks on Hezbollah and their use of pagers that were sabotaged by the Israelis, and then of course the strikes on Friday that killed Nasrallah. So in fact, the recent Israeli actions have killed a great many of Hezbollah's top leadership. It looks like something like 10 of their top 11 leaders, and so there is a feeling in Israel at the moment that this is an operation that has gone pretty much to plan and has actually perhaps led to some greater safety for those in Israel's north.
John, with Nasrallah's death, is Hezbollah beaten, or does this just continue? This is always a cycle, but he was a kind of significant leader for Hezbollah.
He was absolutely significant, and it's obviously too soon to say that Hezbollah is beaten, but Hezbollah is clearly diminished, both by the loss of Nasrallah and other leaders, as well as by the decimation of its communications capability. You know, they had turned to those pagers because they had well-founded fears that the cell phones they were using before were being monitored by the Israelis. So they got rid of the cell phones, went to the pagers exploded. They turned to walkie-talkies, many of which also exploded. So, you know, they are rattled, they are diminished, and I imagine that they, as well as Iran, are trying to figure out exactly what their remaining capabilities are, even as Israel makes further plans.
So among those plans, might we see a ground invasion? I mean, where actually the IDF were to cross the border with Lebanon?
Yes, that's considered very possible. You know, it's not clear exactly when that would happen, but the thought is, you know, possibly in coming days. Interestingly, on nomenclature, we are thinking that it's likelier to be an incursion rather than an invasion, meaning that Israel would send ground troops in to accomplish certain objectives and then come out, as opposed to an invasion and sort of occupation, a longer-term operation as we saw in Gaza.
You mentioned that even liberal Israelis have welcomed these strikes, but we note that they also are saying now's the time to push for peace, push for a negotiated peace. The question is, who do you negotiate with, and what form does it take? If the timing is right to push for it now, what form does it take?
Yeah, that's exactly right. I think that Netanyahu's government is seeing it more as a time to continue pressing its clear advantage against Hezbollah. As you say, there is some question as to with whom Israel would negotiate at this point, but I believe that Israel sees, still further opportunity to degrade Hezbollah's capabilities, and is more hopeful of achieving peace through that means than at the negotiating table at the moment.
It's been nearly a year since war in Gaza. We're talking here about the situation with Hezbollah. What about with Hamas and the Gaza Strip?
Yeah, that also remains somewhat up in the air, and the pressure that the United States and others have been applying for a negotiated ceasefire there, that also seems to be a somewhat distant prospect at this point. Again, as Israel and Netanyahu see their military strategy bearing significant fruit in Lebanon, that makes them, I believe, still less inclined to seek a negotiated peace or even a ceasefire with Hamas in Gaza.
John, we'll leave it there. Thank you so much for making time to chat with us. John J. Edwards, Bloomberg Weekend America's managing editor, joining us from here in New York on Daybreak Asia.
Vance Howard, CEO and Portfolio Manager at Howard Capital Management. Vance, thanks very much for joining us. I'm wondering whether or not we're going to get volatility on steroids this week in China and Japan, given what we heard from Doug earlier. And there's just been such a rush of funds into Chinese assets, and you have this yen strength that could be hurting Japanese assets. I know you're a little more geared up to talk about the U.S., but is it possible that China and Japan really take the lion's share of attention this morning?
Oh, I think that they will. Last year, let's face it, China, with what they did with the PBOC and the number and drop in the rates over there is a game changer. And you look at FXI, which is the ETF of China, it had a very nice breakout. It looks incredibly strong. I don't think you can help but be bullish on China right now. I mean, they're going to throw a lot of money at this. I think they've got 1.1 billion, 400 trillion, I don't know, the liquidity that they're going to throw at this on stock buybacks that came from the PBOC is just amazing. So there's just a lot of legs for the China market to move higher. Now that may affect Japan. I'm not really sure how it's going to affect Japan in the end, but it'll be interesting to watch.
Fed policy drives so much of market psychology. We had this very cool reading on the core PCE last Friday. Is it too much to think that the Fed will do another 50 basis point rate cut in November?
No, I don't think so at all. And I think you look at Fed Chair Powell. I think that he's looking at the unemployment numbers incredibly, hard. He's very dovish right now. But you got the JOLTS number coming out later in the week. That's going to cause a little bit of volatility. But I know the Fed's really looking at unemployment now. Inflation's coming back down. It's dropping at a pretty good pace. So I think that's on track, and the trend is clearly lower. But unemployment is something I think the Fed's really watching. I think if that number comes in weak, I think you're just almost guaranteed a 50 basis point cut.
People like to have victories, and especially given it's been a tough period over the past 3 or 4 years. Should the Fed declare victory here, or, would that be sort of tempting fate?
I don't think so. I don't think the Fed or any governing body needs to declare victory because it's an ongoing fight. It's a never-ending war. And, you never know what page is going to be turned next week and what challenges we're all going to be faced with. But I think Sunday evening here in the U.S., I think we can be pretty satisfied and happy. You've got an uptrending market. There's a lot of money to be made. You've got a tremendous amount of cash on the sidelines. I was looking at the Federal Reserve Board banks money market, the statistic that they put out on the amount of money market money sitting out there, which is about 6.5 trillion. That's an incredible amount of money that's just sitting on the sidelines that can be deployed into good equities in different sectors of the investment economy that's going to push things higher. So I'd be very, very bullish.
So you're speaking to us from the largest city in what has become a swing state. You're in Atlanta, Georgia. We've got an election about a month from now, and I'm wondering whether or not your clients are expressing some concern, some apprehension, and maybe talking to you about shifting their strategies. What's that conversation like right now?
I think this race is so tight that I think that people are really just sitting on their hands. I think what they're more concerned about, if we can keep a gridlock in the Congress and the Senate, I think that's going to be very, very healthy, no matter who wins the presidential election. So I think more people are looking at that and a little bit more concerned about that than they are who wins the White House. But it's going to be a volatile, what do we have, 36 days until the election? So it's going to be a volatile period of time as people sort of decide what they want to do. I think election night, you may see some volatility after election night the day after, because you're going to have a pretty good idea of what to expect going forward.
And when we look at deploying money, given the election coming up and given, the inflation fight and the jobs concern, I like it that you say that, it's really important to think about the math, not emotion. Explain that a little bit for our listeners.
Well, when you look at the trend, two things you don't want to fight is, one, you don't want to fight the Fed. Clearly, the Fed's dropping rates, so that's a very positive sign. Number two is you don't want to fight the trend. And now we use the HCM byline, which that's our proprietary trend indicator, and it's clearly up, it's clearly strong, and all pullbacks should be bought until that changes. But you just don't want to fight the trend. The trend's too strong. There's too much cash on the sidelines to build a base underneath this market, so it keeps it from going, dropping too low or being too volatile, because any pullback you have, we see as a buying opportunity. I think others will too. I mean, if he drops rates another half a basis point, you got 6.5 trillion in money markets. Some of that's going to come off the sidelines into equity. So I would be very bullish, and I'd be buying on pullbacks. There's a lot of opportunities now because the market has broadened out from just being the Magnificent Seven. So it's getting pretty encouraging.
That said, are you negative on the bond market right now? Are those opportunities pretty much, have they evaporated?
Not at all. I think you need to look at other places than 20-year Treasury. The 20-year Treasury's dropped back since they dropped rates, and the reason being is people are concerned about how big our debt load is becoming. Our debt is becoming, astronomically high. But if you look at other sectors of the bond market, look at convertible bonds like CWB. It's breaking out to a very nice breakout of, for the year. It's looking strong. High yields are looking strong. Emerging market bonds, EMB's looking strong, which broke out also. Other areas, the bond market looks strong. The 20-year Treasury is looking a little bit weak, but I think it'll have its day.
We just got this flash from NHK, the public broadcaster in Japan, saying that the incoming Prime Minister Ishiba is eyeing a general election for October 27th. So that's coming up pretty fast. We understand that Shigeru Ishiba's surprise victory has kind of caused people to buy the yen. The yen is strengthening. Do you think most people invested in Japanese equity are hedged, or could this be a potential problem here with the kind of runaway strength in the yen?
I don't think so. I think you got runaway strength in the yen. I don't think they've hedged at all. I think this is, an opportunity over there. The volatility in their market's been pretty extreme, so it's a little bit hard to trade and a little bit hard to judge. But, They've got a lot of activity over there. But again, I would go back to China, be more bullish on China, and I'd look at like FXI, which is the ETF of China. I'd be a buyer of that.
So we were talking about potential volatility. October can be a notorious month for losses in the equity market. Would you be surprised if we were to see, in spite of everything that we're talking about, that would equate with a fair amount of positivity? Would you be surprised if there was a pullback this month of significant magnitude, maybe close to between 5 and 10%?
I would be very surprised if we received a 5 or 10% pullback at this point. The reason being is that about 4 weeks ago we worked off the trough. We had a very overbought market. We saw a dramatic sell-off. We saw buyers come back in, sell off again. Now we're seeing buyers come back in. So I think we worked that off. I don't think you're going to see anything like that in October, and I think we're going to work ourselves through it quite well.
All right, Vance, thank you very much for joining us. You're sounding pretty bullish, and I'm sure you gave a little spring in the step to many listening this morning. Vance Howard, CEO and Portfolio Manager at Howard Capital Management.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.